Welcome to the August summary of our asset allocation on UBP TV. First of all, the outlook for fixed income markets. As has been the case for a number of months now, our outlook is unchanged. We continue to see higher bond yields and recommend that investors keep portfolio duration as low as possible. We continue to avoid core government bonds, where yields have been rising and prices falling. And we prefer credit, in particular short duration, high yield bonds, where the pickup in yield protects us from the negative effect of the rise in yields. We also like unconstrained, non-directional fixed income strategies, which combine a number of qualities that we like. They follow no benchmark, they're flexible in terms of credit exposure, and also flexible in terms of duration. Our preferred currency remains the US dollar. We think it's going to be boosted by the impact of the forthcoming change in the Fed's monetary policy. In particular, the reduction of their asset purchases of US Treasuries and mortgage-backed securities. This will begin to favor the dollar, as monetary policy will be less accommodative than it has been against the euro and against the yen. We think it will strengthen even further against the yen, where we see continued implementation of the Bank of Japan's very aggressive easing of their monetary policy. And we think the dollar will also strengthen against emerging currencies, which will suffer in particular from the impact of rising current account deficits. Hedge funds. Within the hedge fund space, we continue to see great opportunities, which are driven by, first of all, the reduction in the correlation between markets, between securities and between asset classes. And that plays to the strength of active hedge fund managers, such as long-short stock pickers, such as discretionary global macro managers. And the strategy that we've added to our list of preferences this month is event-driven managers, given the uptick that we've seen in corporate activity. Gold. As the global economy heals, as the Fed begins to reduce its monetary accommodation, we've seen a move away from safe haven assets, such as gold, into more risky assets, such as equities. This move has, in particular, been driven by liquidations of holdings in ETFs. The outlook that we have is for an unchanged scenario, which will cap the upside for gold in the short term. In the medium to long term, however, we think gold retains a number of interesting characteristics. The supply-demand imbalance, we think, will increase given the falling off in exploration and given the lack of profitability of many gold mining companies worldwide. And on the other side, we see continued demand for gold from emerging central banks and from private investors in physical gold, in particular in Asia. I'll finish with equities. At the beginning of July, we increased our allocation to equities to take advantage of the pullback in prices that we'd seen in May and June. Since then, global equity markets have rallied back to their highs for the year, and in some cases, such as in the US and in Germany, to all-time highs. This has been driven not by earnings, but by a re-rating with multiples expanding. The next phase will, we believe, be driven by earnings, which we think will begin to pick up given the improving outlook for the global economy in the second half of this year and in 2014. Within equity markets, our preferences remain in Europe and in Japan, and we've made one change to our asset allocation for August. That is to reduce our allocations to emerging market equities and to make a specific allocation in peripheral European equity markets. Our thinking here is simple. In both cases, we have extremely low valuations of between 9 and 10 times 2014 earnings, but we have a substantially better outlook for growth in earnings per share in 2014 for markets such as Italy and Spain than we do for emerging Asia or emerging Latin America. In addition, the dividend yields are much higher in the European periphery than they are in emerging markets. So better growth, higher dividends for similarly cheap valuations justifies the switch out of emerging markets and into peripheral Europe. Thank you for your attention.